That's Raphael. I'm just going to be giving a quick overview on my thoughts on gold and the US economy. So, currently, the state of the US economy is that of high inflation and low growth. Inflation is currently at 8.6%. The economy is not in the best position. There's high levels of consumer debt, increased credit card spending, less homes are being built, and less homes are being sold due to increased borrowing costs. This is whilst the rates are currently only at 2.5%. I believe the Fed can't afford to raise interest rates significantly more to fight inflation. Several reasons for this is Biden reappointed Jerome Powell for a second term as Fed chairman, which in my opinion ultimately makes him a Democrat. And the higher the Fed raises interest rates, the worse the economy is going to be. So there's the US midterms, which are taking place in November, and essentially the Democrats can't afford for a recession to take place whilst they are in control. So obviously they're going to try and do as much as they can to prevent this. And currently, the US debt in America, well, the US debt is currently close to 30 trillion. So the higher the interest rates, the more the government are going to have to pay back. And of course, it's in their best interest not to do so. So in 2008, the US debt was less than 6.5 trillion, and the Fed stepped in order to help prop the economy to provide liquidity. They did this by lowering interest rates. However, the main difference right now is that the situation is currently much worse than it was in 2008. So in 2020, about one fifth of every US dollar in circulation was printed. So the QE, the quantitative easing, was about 3.3 trillion. Wow. A lot of investors believe that the Fed are going to have to carry on with their hawkishness in order to fight inflation, and they're going to have to raise interest rates to deal with that. And this week, well, certainly yesterday, we had the Jackson Hole Symposium, which is essentially where all the central bankers, key financial figures, key people in the economic realm, they gather to discuss the US economy, discuss other world economies, and essentially what they're going to do moving forward. So this is going to be a key indicator to try and understand the Fed's positioning, how they're going to likely to respond, and what their plans are. Although we don't get a detailed look into what actually goes on, we do get summaries throughout the day, throughout the event, of what is going on. Investors try to piece this information together to try and decipher what the Fed's plans are and how it's going to essentially affect the market. So during this week, trading hasn't been the best. It's been quite choppy. There's been a lot of contraction, a lot of consolidation, and of course, this is due to the high impact news, that the volatility that comes with this event. So it's always advisable or suggested whenever, me personally, whenever I know that there's an event like this happening, I always look to mitigate my risk by either reducing my position size, my lot size, moving any open trades to moving my stop loss of any open positions to break even, assuming they're in profit, and then also looking just to not trade during this period and just to kind of sit on the sideline and just get a better understanding for how things are going to be moving forward. So I personally believe that it's gonna be interesting to see what is happening. We have the main talk from Jerome Powell, which will be taking place later today. So that's going to be interesting to see how what hints he drops, to see what hints he drops regarding interest rates, regarding the economy, and let's see how the market interprets that. So traders are aware that as interest rates rise, that's bearish for gold. However, I'm still bullish on gold in the long run. So despite interest rates they're going to rise in the short term, overall I'm still bullish because I believe that the Fed are going to have to drop rates sooner rather than later. I was having a look at a Bloomberg report, and the CEO, the chief economist, Goldman Sachs chief economist Jan Hatzius claims that he anticipates the Fed raising rates to 3.5% to deal with inflation. However, in 1981, Paul Volcker, the then Fed chairman, had to raise rates to 20% to deal with 18% inflation. And this was whilst the US debt was at less than 1 trillion. So it's interesting to try and understand how can a 3.5% interest rate deal with 8.6% when back then there was less debt, and a significantly high 20% interest rates was required to deal with that 18%. Doesn't really make sense to me, but I believe honestly that the Fed are going to have to be more focused on fighting the recession rather than the inflation. So if they have to pick between the two, they're going to pick the former, which is fighting the recession, because it has more dire consequences, I believe, on the economy and also on the status of the Democrats, um, who are the party in power currently. And it's also quite amusing when the Fed, the media, and other officials began to change the definition of a technical recession, because the US had two consecutive quarters of negative growth, which indicates a recession. But before the news was released, there was a few news reports. A few officials from the White House were basically saying that there is no technical definition of a recession. They were just almost trying to change the description, the definition of a recession, because it's not in their favor, right, for a recession to occur at this time. And during times of uncertainty, so a recession, what's going on currently in Ukraine, investors tend to flock to safe havens, and gold is one of the best safe havens. And so that's mainly why I'm bearish on the USD. And I would also say there's other reasons why I'm bearish on the USD. So, for example, now if we take a look at the high levels of debt the US currently has, we also have a look at the relationship the US has with Saudi Arabia. So, I've read articles that the Saudi Arabia basically going to take payment from China in yuan as opposed to the dollar. So there's been a lot of rumors that the dollar is going to lose its reserve status. It's going to lose its status as the reserve currency of the world. There's a new BRICS. The BRICS economy are looking to form their own dollar. The BRICS economy are looking to form their own global currency, which is going to be, some are saying that's going to be linked to gold. I was having a look at a great article that was on the capital.com's website regarding gold, which is a very interesting read. Yeah, I would suggest definitely having a look at that. But yeah, it was basically saying that the the BRICS economies are basically going to form their own just because of the mistreatment that the LBMA has given them, and it makes sense. It makes sense. So I believe there's definitely going to be a lot more demand for gold in the short term due to the increased supply. We can see as Russia was sanctioned, there's going to be more supply coming onto the market, which essentially could affect the price of gold, but I believe it will soon begin to stabilize once the market is accustomed to this level of supply in the market, and also there is a lot of demand for gold. So yeah, that's definitely going to be interesting to see. Now, that's just a breakdown on my fundamental analysis. And also another point to mention is during this during this war with Russia and Ukraine, so we can see how the dollar was essentially weaponized against Russia, right? So we can see that a lot of Russia's foreign reserves, which were dollar denominated, were seized. I believe 650 billion of their international reserves were seized. So this is even more reason why the BRICS economies are looking to move away from the dollar, especially Russia and China. They've been in a lot of talk. They've been stockpiling gold for a long time now, and they're essentially looking to move away from the dollar. Another key point to note is that China are one of, if not the largest holders of US treasuries. So given in a let's say for example now there's also another incident where China could invade Taiwan, that would be another global scale which would cause panic to the markets. It would send the markets in turmoil. Where investors are going to go again? Gold. Bullish. Yeah, I'm very bullish on that. So yeah, I would say fundamental analysis is key to forming your understanding of the markets, to forming your understanding of trades, and then what I do is I have a look at Forex Factory. So this shows me when there is low impact news, which is in yellow, medium impact news, which is in orange, and high impact news when it's which is in red. We can see this week there's been a significant amount of high impact news, but the key one that most investors have been anticipating is the Jackson Hole Symposium, which began yesterday, Thursday, August 25th. So I'm just going to go to my charts now. So once I have that understanding of the fundamentals, I then go to the technicals and I look to form a trade ideas. I look to see where the market is and what I can potentially look to get in. So here we can see 2008, following the crash, price rallied. There was a sustained rally, and the all-time highs were formed in August 2020. Now, if we drop to the weekly calendar, we can see that price has been bearish. A lot of swing lows have been taken out, and this current leg, which we're in, this current leg from week commencing 13th of June, we can see that price made a large decline, took out this swing low. This swing low is yet to be taken out, but there is a lot of liquidity which is built up here. So I believe this is definitely the next level that price is going to look to target. And let's say, for example, now following the Jackson Hole Symposium, investors believe that the Fed are going to raise interest rates. This gives even more confluence that price will target here. And the reason for this is because obviously there's a lot of stop loss orders that are below this level, and that is sell side liquidity. So what I do is so when I say sell side liquidity and stop loss orders, so let's say, for example, now swing traders or even day traders, when price gets to this level here, they think, okay, this is a strong level of support. As price begins to rally, where they're going to put their stop loss here. Price begins to decline now, comes again, fails to take out this level significantly. Wow, what does that mean? That's a very strong level of support. As it begins to rally, it rejects this level, so it rejects 1680. And this is, we have this long wick following this doji candle, then price begins to rally. Again, investors, traders are going to be putting their stop loss here. Price then begins to rally. We're in a consolidation, rallies higher, but now we can see that the market has shifted from bullish to bearish as all these swing lows have been broken. So it comes again on the 21st of July, stop loss is put here, again more. So there's a lot of liquidity being built up in this level. So in my opinion, a trade I would be looking at is taking a short from where we are at now to essentially 1670. Let's say now, and I'm going to drop to the lower time frames, but just from where we are now, that is about 750 pips, which would be a very nice trade. So following this current leg here where we had price, essentially this is like a head and shoulders candle, not candle but head and shoulders. So you have the shoulder, head, shoulder, and then so this is a key reversal candle, a key reversal pattern. So we can see we had the first shoulder here, the first head, the head here, and then the second shoulder. Then we had this large bearish engulfing candle which took out this swing low. This was on the 15th of August, and price has been retracing. We took out another swing low which confirms bearishness. Now following this retracement, so this decline here, Price made a retracement to the 50% level, and a lot of traders believe that 50%, can you see that? Yeah, 50%, this has gone, so above 50% indicates a premium market, below 50% indicates a discount. So following here, we could have looked to take a short. Let's say want to take a short on the daily chart. Not recommended, but let's just say, for example, took a short here, stop loss above this high, 77 pips. This would definitely be a swing trade. And even if you look to just target this swing low, which price is left here on the 22nd of August, that would be a 1 to 4.8 trade. Very respectable. However, if I believe my analysis is correct and price then targets here, you're looking at nearly a 11 to 1 trade. 11 reward compared to your 1 risk. So I believe this is what we're looking for on the market. This is what we're looking for on gold. And if I drop to a lower time frame, so let me put this on the daily. Now if I drop to a lower time frame, so if we look at the 4 hour, so we can see here that this is the retracement price made. So this was Monday's trading, Tuesday, Wednesday, Thursday, where we're at now. So as we're bearish, as I'm bearish, I should say, in the short term, I would expect price to potentially look to take out the previous day high, which is 1765.55. I'd look for price to take this previous day high, take out this previous day high, form the high of the day, and then head lower. But because it's Friday, there's a lot of volatility, anything could happen. But essentially, we can look for to take out this liquidity which is below here. So essentially, you could look at something like this. And we can see this to end the week, but due to the high volatility, which is today, so we have 130, the core PCE price index. Another reason why I love Forex Factory, I'm a big fan of it, is the detailed analysis, the detailed information, the specs that it gives you. So why do traders care about the core PCE price index? So it's the Federal Reserve's primary inflation measure. Inflation is important to currency valuation because rising prices lead the central bank to raise interest rates out of respect for the inflation containment mandate. And it also tells you what the previous results were. So July 29th, 2020, we can see that the forecast was 0.5%, whereby the actual was 0.6%. So it gives you quite a detailed information, which is why I really like it. So we can see we've got high impact news at 1:30. Then of course we've got the equities opening, which is at 2:30. Then at 3 p.m. we've got Fed Powell speaks, and overall we just have the increased volatility from the day because of the Jackson Hole Symposium. So yeah, it's going to be very interesting to watch. But as I said, short term, bullish on, bearish on gold. Definitely anticipate price coming down to about the 1680 level, taking out all the liquidity that's built up below here in the form of sell stops, because as I mentioned earlier, when buyers go long, they have to have a sell stop to mitigate their position. So there's a lot of liquidity built up here, strong support. Retail traders are going to believe this is a strong support level, so a lot of their positions, sell stops, are going to be here. Price is making a retracement before heading lower, in my opinion. Again, this is not trade advice, this is just my opinion. So once it heads there, then I would kind of sit on the sideline and just not anticipate, but just observe how price is reacting, and then look to make an informed decision based on that. But as I said earlier on in my fundamental analysis, I believe that the Fed don't have the capacity to ultimately fight inflation because recession is going to be more important to them. So as this is a very large bubble, as the Fed raises the rates, the economy is going to get worse and worse. Essentially, quantitative tightening is going to stop. QE, quantitative easing, is going to begin. Rates are going to lower, and gold is going to be able to rally higher. And that's it for now. If you have any questions, feel free to ask me. I hope this has been useful, and I hope you have a wonderful day.